Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Daryl Thomas, and today we have the pleasure of interviewing a buddy of mine, Andy Schectman. How you doing today, Andy?
Daryl, I'm good, my man. It's always good to be back with you, bud. Good to see you. Thanks for having me. I appreciate it.
Yes, of course. So, obviously, we got some stackers that watch the show. We got some gold and silver mining investors that watch the show and such. Let's start there. So what's kind of your thoughts on the current state of the metals, and where do you see things headed from here?
Well, I think, it's a very broad question. But when we talk about the metals market, I guess I would start by looking at what's happened with the war, right? So we are supposed to believe the conventional wisdom that talks about the old argument that talks about rising interest rates are bad for gold. In my mind, that argument is dead. In the respect that, the war spikes oil spikes the CPI, the Fed cancels rate cuts, and that crushes precious metals. That's what my dear departed friend Jim Sinclair would have called MOPE, M-O-P-E. That means management of perception economics. That's what they want you to believe. But the market and the deliveries and the central bank buying, in my mind, tells a very, very, very different story. And, I think that when you take a look, like, for example, let's look at China. China has cut its treasury holdings in half, going from 1.3 trillion, roughly, not too long ago, down to 650 billion. That's the lowest level they've had in almost 20 years. And based on their accelerating gold purchases, now 17 straight months, it would seem to me they are reallocating this money into gold. And this follows a trend we've seen for several years with central banks buying gold, over 1,000 tons again last year. And again, the counterparty trust element, countries like Germany and France, who just made another big deal about bringing their gold back from the New York Fed in India, from the Bank of England, repatriating their gold. Others are doing the same thing. The message is simple. Nations that once trusted the dollar are moving into gold and silver that they can actually hold. That's why this old argument of rising interest rates are bad for gold is dead. You see, they want us to believe that. And it's interesting because I go back, I've been doing this 36 years, Daryl. I go back to every single war, back to the original Gulf War, and two things would always happen. Number one, gold would sell off because there's a rush to dollars. The argument is that you throw out the baby with the bathwater to get liquid, and gold is the most liquid thing. These countries, as the dollar is getting stronger and oil is priced in dollars, it hurts them doubly around the world because they have to buy oil in dollars. So they sell their currency, they sell their assets, they sell in this case, they're selling their treasuries to get into dollars, which gives the dollar a bump so they can buy oil. So what typically happens is that the dollar gets a bump, assets get sold off, but not treasuries. Typically, treasuries go the other way. The treasuries go up and interest rates go down. People typically buy treasuries during times of stress and fear and war because the treasury market is the most liquid, safe, trusted market on the planet, right? Well, it's going the opposite. Since the war started, rates on the 10-year up 45 basis points. And that is indicative of countries saying, we don't trust the system anymore. We don't want treasuries. And so when I look at a price of gold that has fallen the way that it has, to me that is management more than anything. And the conventional wisdom that we are supposed to follow, I don't believe. Why do I say that? Well, let's talk about, for example, China. In the month of February, when silver was getting its teeth kicked in, China imported, according to import records, more silver than they have ever imported in the history of recorded markets. Ever.
Wow.
In the month of February, and they're the second largest producer in the world, right? Why are we seeing deliveries on COMEX at a level that no one's ever seen before, month over month over month over month over month? And again, let's look at February as an example. February, when the price of gold and silver were getting their teeth kicked in, is a non-delivery month. Typically, it's like January is, February is not, March is, April right now is not, May is. But you can still take delivery. In February, in terms of silver, there was about 25.5 million ounces delivered, which, again, my whole career, Daryl, no one ever stood for delivery. Less than 1% of contracts stood for delivery. It was the anomaly. Now we're seeing massive deliveries. The majority of the contracts that were posted stood for delivery in February. 25 million ounces. That's a lot. That was one of the smaller delivery months in the past 18, but at $70, you're at 1.5 trillion? Billion, excuse me, $1.5 billion. But of the 25 million plus ounces that stood for delivery, 39 million ounces or thereabouts left COMEX. Left. That's 2 million pounds of silver got on trucks and went by, left the building. Now, that's 160% of what deliveries could explain alone. Who in God's green earth is standing for delivery and taking possession? 39 million times, call it $70 even at that point, which was higher than that, but let's just use 70. 39 million times 70, $2.73 billion worth of silver just said bye-bye and left COMEX. Now, who did that? Who arranged the trucks and the logistics and the insurance, and where the hell did it go? So what I'm saying is, when you see central banks, China for 17 straight months, right? All of these central banks, Poland and on and on and on and on, Brazil, now it's the second largest holding is of everything, is gold right now. Gold has now overtaken dollar reserves in terms of global holdings for the first time ever. So the deliveries by the central banks and by the biggest traders, the most well-informed traders on the planet, you look at the bleed downs in Shanghai, you look at the deliveries out of the LBMA, you look at the deliveries on COMEX. These traders ain't you and me. These traders ain't even the people that we think are sophisticated. These are the most sophisticated, well-informed, well-funded traders on the globe that are saying, great, we're going to shake all the speculators out by raising margins and creating volatility and counterintuitive thought. Now you get all these genius talking heads that say, well, you know, gold has lost the anti-correlation to the markets. In fact, when the markets fell because of the war, gold fell more than the S&P. It's lost that inverse correlation. In fact, it has a positive beta moving in the other direction. Don't buy it. Well, that's such a bunch of crap because, again, if you think about it for a moment, that's what they want us to think. Number one, that's management of perception economics. But if that were really the case, then why are the deliveries across the globe accelerating? Because the most well-funded, well-informed traders in the world use that narrative, that speculative, the speculators get blown out by rising margins and a price that's getting hammered, and so they get margin called, and it's lost its correlation. But then they all say thank you very much and stand for delivery at subsidized prices because they're not using margin. Now that's all ignored. And when we talk about the fact that no one is rushing to treasuries like they used to, that's ignored. And it's convenient when they say, well, rising interest rates, Johnny, well, that's bad for gold. Well, how about the fact that after COVID, interest rates rose the most in a short period of time that they ever have risen ever? In terms of, from like 0.3% up to where we are now. Gold has almost tripled since then, right? In a rising interest rate environment. They ignore that, but the Fed's not going to lower rates, so that's bad for gold. If the dollar was trusted, if our markets were trusted, if our institutions were trusted, if our country was trusted, then that would be valid. If the dollar was strong and everyone wanted it and everyone wanted our treasuries, that would be valid, as rising rates would attract money into treasuries because gold pays no interest, right? Mm-hmm. But it ain't true because no one wants it anymore. No one trusts it anymore. It can be weaponized. It can be inflated. We have the fiscal irresponsibility of a third grader in a candy store with mom's wallet. It doesn't work when you have a system that is based on trust that is no longer trusted. So rates are going higher because no one wants our treasuries. And if you look at a country like China as a perfect example, which has cut its treasury holdings by 2/3 over the last several years And instead they're buying gold with it, 17 straight months that we know of, and they're the largest producers in the world. And I guarantee you, the import-export numbers that are reported to the IMF are voluntary. They're reporting bringing in a bunch of stuff that's not recorded or reported. If the People's Liberation Army buys it, they have no obligation to report to the IMF. If a proxy bank on behalf of the PBOC buys it, they're not going to report it. And the Chinese already got busted by the import-export numbers coming out of Switzerland 6-7 months ago. Oh, that's right, we did it. Sorry, we didn't report it. The numbers are far greater. And I just simply think that those people that are using or looking solely at price, and I get it, they're bummed out by the counterintuitive nature. It is exactly what they want you to do. It is misdirection. It's the no-look pass. They don't want to be crowded out of a trade. Do you think there's any coincidence, Daryl, that for 18 straight months we've seen these kind of deliveries where before less than 1% of contracts ever stood for delivery, but for 18 straight months we've seen billions and billions, I would do this 18 times, billions every single month, and then by chance, silver's now a critical mineral. Shh, don't tell anyone. Yep. And we're going to put a floor underneath it, and we are going to do Project Vault, state accumulated program of stockpiling these critical elements. None of this stuff is by chance, but the last thing they want is for speculation and the word to get out, crowding them out of their trade. But then just ask yourself, in the month of February, who stood for delivery for 2 million pounds and left, right? 2 million pounds plus left COMEX. Who the hell did that? But that's every month. Now, I'm not saying every month we're seeing that kind of volume leaving on the loadouts. We're seeing a lot. Some of it stays in. Well, 2-3 weeks ago Friday, staying in the eligible category, which are not the bars backing the contracts registered, 2 million ounces of silver, goodbye, just left COMEX. Where did it go? Is that Samsung? And then you see China say, well, we're not going to export sulfuric acid anymore, which you need for copper mining. Silver is a massive byproduct of copper mining. In fact, the majority of silver mined comes from byproduct mining of copper, lead, and zinc.
Yep.
Well, if all of a sudden the copper is going to get crushed, well, what does that mean for silver? Do you think companies like Tesla are going to wait around to find out? Or are they going to say, give me that 2 million ounces of silver, I need to take possession of it right now. I'm not leaving it in the ecosystem to find out. What I'm trying to say is the conventional argument is dead wrong. And this is why there's an entire school of theory for investing called wave theory, Kondraty of an Elliott wave. The media says bad, gold's lost its correlation, anti-correlation to the markets. Market sells off, gold sells off more. It's not the safe haven in the midst of war. Sell it, it's bad. And everyone panics and sells, and the speculators get hammered by raising margins. Even the IMF came out and said, it was either the IMF or the Bank of International Settlements, or both, that the sell-off we saw was structural, not fundamental. Structural because it was largely due to levered ETFs that were being rebalanced and sold off and margin increases. This wasn't a fundamental correction. This was structural. It was manufactured. And at the same time, if that were true, if price was a true reflection of demand, then who the hell is standing for delivery? Why did China import more silver in the month of February than any time in recorded records ever? Mm-hmm. Because price is a tool of misdirection. And the big money understands this. So pull back from your emotions, Look at things logically, and you'll see that this is setting the stage as the weak and speculative hands have been flushed for a leg higher. Now, I'm not telling you to buy it to get wealthy. I'm telling you to buy it because it is wealth. And the most well-informed traders across the globe, the central banks largely, and whoever the hell is doing it here in the U.S. and in China, bleeding down the Shanghai Exchange, and the wicked deliveries out of the LBMA, these people know the playbook. These people are 4 or 5 steps ahead of the public because not only are they the most well-funded traders on the planet, they're the most well-informed traders on the planet. And that's all you need to see as far as I'm concerned.
Yeah, for sure.
Our project is right in the southeastern corner of Wyoming. In the space of 4 years, fully engineered, fully permitted.
The ASIC is what caught my eye, $937 per ounce.
110,000 ounces per annum. First year of production is the most impressive. 132,000 ounces of gold, 24 million pounds of copper. You really want these things front-end loaded like that. US Gold Corp is a near-term, low-cost gold producer in Wyoming. To learn more, go to usgoldcorp.com.
I was reading about the, when Nixon closed the gold window and everything, what was all going on then. I know the central banks had got together in the 60s to try to cap the price of gold.
Gold pool, yep.
Yeah. And so, and then France, during that time, came over with ships to get their gold and such. And so, France recently came out, saying that they were going to get, what they say they're going to get the rest of their gold or whatnot. Just curious, and is that them coming to like the U.S. and getting the gold out of Fort Knox? What does that look like?
Well, yeah, I mean, in 71, when Nixon closed the gold window, it was largely because of de Gaulle from France, who realized that the guns and butter platform that we had, that we were printing more dollars than we had in gold at Fort Knox. They understood this to fund largely the Vietnam War. So he sent warships over filled with dollar bills to New York Harbor, said we want our gold, and we gave it to him largely. Bled down over a period of time over half of the gold that the Treasury held, and that's why he temporarily closed the gold window. Hasn't opened back up yet, by the way, but that's why he did it, because they were all calling our bluff, and that's when the good as gold guarantee ended. From the end of World War II until 1971, we told sovereign governments that you can at any time, we'll take your gold, we'll pay you $35 an ounce for it. Take that money, invest it in treasuries. You'll earn a yield on your non-yielding asset. We'll hold it for you. You guys have been in the midst of 2 world wars. Safe over here. We'll hold it. You can always get it back at $35 an ounce. In the meantime, you don't have to store it, and you can make a return. You benefit our economy. We help you. Everyone wins. And so they could exchange their gold for $35 an ounce, and then Nixon said, "No, game over. We're going to keep the gold. Sorry." Which ended the backing of gold for the dollar. It was 2 years later that Kissinger went to Saudi Arabia and struck a deal with the Saudis for the Petrodollar, which seems to be waning right now. But as far as France, look, for 50 years subsequently, countries would hold their gold at the New York Federal Reserve and at the Bank of England. And the reason they did it was less for diversity and more for access to the markets. The COMEX market is the global price-setting market for gold and silver. So they would leave it at the New York Federal Reserve, safe jurisdiction, Western rule of law, wink, wink, and they could have direct access to the COMEX. Same thing with the Bank of England and the LBMA. When you saw Germany in 2017 make a massive stink about getting their gold back, which they'd been trying to do for 3 years, and finally took out articles and editorial articles in the Wall Street Journal, give us our damn gold back. But that should have got more attention, because right after that, the Dutch National Bank, the Bank of Turkey, Hungary, Poland, the Czech National Bank, they all did the same thing, give us back our gold. And now you're seeing France, you're seeing India repatriate all their gold from the Bank of England. France just got their gold back. Germany wants the rest of their gold back. It's a lack of trust. This all boils down to trust. No one trusts the Treasury market anymore. It's been weaponized against Russia. We defaulted and stole their treasuries that we were holding, and worse yet, largely gave the proceeds to the country they were in the midst of a war against. When you are the world reserve currency, a country that invaded Iraq 22 years ago and still went there under false pretenses, we never found those weapons. And I am not making a statement against this country. I'm a patriot, and I thank God I live here and was born here. But look, if you don't look at the other side, at the way they look at us, then you're a fool. It's like being accused of murder. You murdered your wife, and the attorney says, "Listen, I don't need to know the state's argument. I don't care. I just want to hear your side. I'm not even going to read their file." Well, that's stupid. You need to know both sides. And the way they look at us, so those guys came into Iraq now going on 23 years ago under false pretenses, destroyed their country, destabilized everything. Out comes, ISIS out of all of this, destroys their regime. They're still there occupying their country 23 years later, and they can pass judgment on who can protect their own countries. And again, I'm not passing judgment on the Russian-Ukraine war, but for us to act as judge, jury, and executioner as the world reserve currency, no one trusts that system anymore. That's why you're seeing alternative payment systems, the SIPs, the cross interbank payment system, the M-Bridge, all of these alternative payment systems using central bank digital currencies settling in balances in gold instead of holding treasuries. That's what this is all about. It's a lack of trust in our institutions, in our markets, in our geopolitical and political aspirations and direction. A system based on trust, not based on gold like it was prior to 71. I don't care if I trust you, give me back my damn gold. Well, no, we're changing the rules. These things, I think, have manifested into a point where trust is everything, or in this case, lack of trust. And people, countries don't trust us anymore. That's why China is selling all their treasuries and taking it and buying gold instead. That's why you're seeing central banks repatriate their gold from the most liquid market on the planet. But all of a sudden, you're starting to see exchanges pop up in Shanghai, in Dubai, the BRICS exchange that is being built in St. Petersburg, in Moscow. All of these exchanges, will be the rails of this new payment system where we trade with each other cross-border in rails that are not compatible with the SWIFT and settle imbalances, trade or currency in gold. That is the death knell for the dollar. So, big picture,
quick question on that. So, like the war with Iran, it seems like it was very blatant that there's a problem with the petrodollar system. I mean, Iran came out and said, "Hey, if we'll export if we sell the oil in yuan, and oil's been sold in dollars since the 70s, since this system was set up, and so it seemed like a blatant shot at the petrodollar system on the national stage, or international stage. So I'm curious." How does this play into the BRICS initiatives? I mean, even now, like, is Iran a BRICS country now or something like that?
They are, yep.
And I mean, I'm sure it's going to drive them further towards the BRICS and alliances with the East or whatnot. And so just curious in your thoughts on, what happens on that front. What do you think happens?
Well, I think, the petrodollar system isn't as tight as it used to be. To your point, less oil is being priced in dollars, and fewer of those dollars are being recycled back into U.S. assets. Look, you could argue, Daryl, that the U.S. dollar is still dominant, but its share of global reserves has been falling for 25 years straight to its lowest level in 25 years right now. When the central banks, which are the institutions that issue currency, are consistently exchanging paper for gold, to me, that's not noise, that's policy. Brazil just doubled its gold reserves. Gold is now its second largest reserve asset. And this is what a slow global move towards a neutral reserve asset looks like. It's happening in real time. So when you realize that the biggest part of the petrodollar deal isn't the fact that governments have to price their oil in in dollars, rather. It's that they have to take the excess dollars and recycle them into U.S. treasuries. When you see interest rates rise in the midst of a war, every war that I've lived through since I started doing this 36 years ago, interest rates went the other way because countries would pile into the safest asset in the world, treasuries. Now it's going the other way. They're selling treasuries and buying gold. 17 straight months for China. So I would simply say to you that it's misdirection at very best, and the U.S. Treasury market is the Achilles heel to it all, because it all boils down to lack of trust. And what's good for the goose ain't for the gander, evidently. And so I think that doesn't bode well for the long-term future of a government that isn't trusted and has massive fiscal irresponsibility. Not a good omen for the future prospects of a stable, strong debt market here in the United States.
Yeah. So, I mean, the BRICS was, obviously a hot topic for a while. I haven't heard much about the BRICS in, probably, it's been some months. I'm curious. It seems like this whole lack of trust and this continuation of, weaponization of dollars, or let's say, United States doesn't like what another country is doing, and we pretty much sanction them or attack them, whatever the case may be, right? That seems like it's going to drive more nations towards, a BRICS, or whatnot. And so I'm curious in just your thoughts in general on the BRICS. Like, obviously, Russia has been giving Iran like intelligence and satellite images and things of that nature. There's also some talk about the drone capabilities and weaponry and such. And China has invested interest in this. And it seems like, I mean, to me, it seems like a proxy kind of situation, proxy war with like China and Russia in some ways. And so, and both of those are major BRICS nations. And so, yeah, curious in your thoughts on the BRICS in this.
This strengthens the argument for the BRICS. I don't think the reason you haven't heard much about it is because what the Bank of International Settlements did right before the last big BRICS meeting, where they came out, not the one in Brazil, but the one before that in Russia, where the BIS pulled out of Enbridge and said we can't be a part of any technology that would allow countries to sidestep Western sanctions. But they had been working, the BIS, with their innovation hub with China, Hong Kong, Thailand, and the UAE for 5 years developing Enbridge. It's like they just realized that Russia was the R in BRICS and pulled out and embarrassed them at the 12th hour. And so they said, screw it. Not only do we not want to antagonize Trump, but we're not going to get screwed by the West again. So Enbridge is operational. You don't hear much about any of the BRICS things because that's by design. I think after Trump is gone, that may change. But is there any difference between us providing the Ukrainians with satellite imagery and weaponry and all of the things for them to fight the Russians, so the Russians do it back? I mean, it tit for tat, I guess. The BRICS, this type of behavior that we have, and the fiscal irresponsibility, and the going around the world with a stick instead of an open hand and an olive branch, is exactly what formed the BRICS. China just came out today and said, more or less, do not screw with us, that we still have contracts with Iran that we intend to keep and uphold, and do not mess with us coming through, or they called it the Chinese wall, iron wall, I think. She just said this, that you will, that will be met with like the 1.4 billion person Chinese wall. They're threatening, do not mess with us with what we're doing. So, yeah, I think ultimately, short term, yeah, it's probably not something that the BRICS are going to want to be very boisterous about. Long term, this is where strength in numbers comes into play. This is where fiscal irresponsibility and geopolitical plans that perhaps are maybe, look, going around the world with force maybe doesn't work the way it once did. And I think that's what's being discovered right now. So these countries in and of themselves do not want to mess with the U.S., but put them all together and they become much stronger. Ultimately, I think it benefits the BRICS and doesn't benefit our country one bit. But I guess we'll have to see. It's certainly not the last we've heard of the BRICS. Okay,
so one thing that I've been processing and just thinking about is, with the escalation in the Middle East, I mean, there's, talk of a blockade. We're going to go, do a blockade. Obviously, there's still negotiations, and this conflict is changing by the minute, right? If Iran is able to hold off the United States Army, or keep these aircraft carriers from really being able to do anything, or keeping the strait closed and such. I mean, that seems like it's going to send a signal to the world that, maybe the U.S. military isn't as mighty as it once was, or at least, okay, well, maybe the Army's too big and it's not as flexible and nimble or whatnot to be able to handle some of these intricacies of, with drones and things of that nature. And so I don't know, it's just been kind of something on my mind, like where, if Iran is seen as having won or outlasted the U.S. in this conflict, it's going to send a big signal to other nations around the world. Curious in your thoughts on that.
100%. I mean, 100%. At least first in terms of economically, you got Kristalina Georgieva, the head of the IMF, said all roads from this conflict lead to slower growth and higher prices. And I agree with that. I mean, geopolitics just reinserted the reality that, you know, the inflationary input from what is happening right now, that when you see energy or the cost of oil move much higher, everything reprices: freight, fertilizer, food, manufacturing, everything, all of it. And in terms of the fallout, if this continues, those ramifications get far worse across the board: fertilizer, liquid natural gas, oil and gas, and that then, you know, moves from just the price of gasoline and oil like we see right now, where the increase in the CPI, 75% of it was attributed specifically to gasoline. That's bad enough, right? But again, you know, it starts there, bleeds into things like delivery times and input costs and margins and packaging and groceries and then
chain.
earnings. Yeah, and earnings and then layoffs, and that's how these things start to unravel. That's if we stay there and decimate things worse in terms of the infrastructure, the oil infrastructure and whatnot. And if we leave and Iran still has control of the Straits, yes, we've been knocked off the peg, at least one or two pegs in the dollar hegemony, where we've been protecting all of these countries through military might so that they would value oil in dollars and recycle those dollars into treasuries. This petrodollar system isn't as tight as it used to be. Less oil being priced in dollars, fewer of those dollars being recycled back into U.S. assets. And you know, again, I think that we're kind of trapped right now. Either you go in and finish the job, or if not, and it becomes another Afghanistan where we leave in disgrace. And all of a sudden, what happened there? The Taliban's back in control. We were in Iraq 22 years ago, still there, and here comes ISIS. So we've had to deal with them. But the point is that if we leave and things are in disarray, worse than when we got there, or Iran is still in control of the Straits, yeah, these countries say, what the hell do we want to be associated with a country that has fiscal irresponsibility and their military might is only so good, they can't even deal with this. And again, I'm being somewhat generalizing, right? But I think that is indeed a valid point, to your point, that one way or the other, it's going to disrupt the global natural order of things.
Yeah, so a couple of things with that. So obviously CPI has been trending higher, and this has to do with the supply side of things, because supply of energy, fertilizers, things of that nature.
That's not demand-driven.
Being disrupted, right? So as far as the demand-driven side of things, you mentioned something earlier that was really, really critical, where who's buying our treasuries, right? In this midst of this conflict. And these treasuries have to be bought to fund our government spending. President Trump came out and said he wants to increase the military budget to $1.5 trillion.
Which is discretionary. It is not mandatory.
Yeah. And so, and all this stuff is like, okay, this stuff has to be funded.
How about the $10 trillion in treasuries that are being rolled this year that need to be either paid or rolled forward? $10 trillion against the $5 trillion in tax revenue. That's a problem, because that doesn't even talk about what we have coming this year, the $3-4 trillion in deficit spending. So yeah, your point is very valid. Who's doing it?
Yeah. So, I mean, obviously, in like Ray Dalio's work and such, he talks about this is where the Fed comes in and backstops the government and, increases the base money, the M2 money supply grows and such, and the purchasing power of the currency, falls even further and such. And so is that your base view, that the Fed's going to come in and pretty much have to, they're pretty much got to print and fund the government?
They're doing it right now. They're calling it something different. They're buying $40 billion a month in treasuries, because who the hell wants to do it? That's the whole concept of the Genius Act, by the way, which it isn't getting enough attention. The Genius Act, which goes into effect next year, January, says that anytime money moves, it's going to be on a stablecoin network. backed by 90-day or less short-term treasuries. Well, what does that do? That creates synthetic demand for the front end of the curve, pushes interest rates on the front end, the overnight lending rate down to near zero, which neuters the Federal Reserve, by the way, because they are only allowed to mess with the front end. They're not allowed to buy the back end, at least by law they're not. Doesn't mean they don't. They buy the front end because they realize that the organic demand for the Treasury is dying. And especially the longer maturity treasuries. That's where Judy Shelton's idea of backing the back end with gold comes into play. And the front end is now going to be controlled by the Genius Act, and the movement of money anywhere across the globe in U.S. dollars will be backed by short-term treasuries, giving that synthetic demand. I just think that it's crazy to think who would buy our treasuries when money creation is running far higher than the yield on the treasury, when inflation is running much higher than the CPI. I mean, the CPI would ever tell you it's a lie. The CPI, it is. And when coffee was too expensive a year ago, April, they substituted, I think, with tea. Because who in their right mind would drink coffee if it's up 85%? Or if steak is too expensive, well, they'll substitute with ground beef. Because who in their right mind would eat a steak if it got too expensive? They continue to change. And that's why John Williams of shadowstats.com would tell you can add an 11 in front of the 3% inflation that we're told. And inflation is closer to 14%, not 3%. And so when you talk about a Federal Reserve that has been striving for 2% and is in essence has stopped QT, quantitative tightening, moved to $40 billion a month in purchases when they're 50% plus away from their target. That's like, getting to the 50-yard line in a football game and saying, "Good job, guys, forget the other 50, let's go back the other way."
Mission accomplished.
Well, that's what they're doing. Yeah, well, and that's in essence what they're doing. Holding your money in 10-year treasuries is absurdly foolish because not only is the inflation numbers manipulated, or are the inflation numbers manipulated, so too are the treasury yields by things just like this where no one wants to buy it, so the Fed comes in and quietly buys it. They've been doing it all along, just haven't been telling us, unless you believe the Cayman Islands is actually number 2 or 3 in treasury purchases. Really? Or is that a shell corporation on, quietly on behalf of the Fed buying our treasuries? So, yeah, I think organic demand for U.S. treasuries that can be confiscated, that are, fiscally irresponsible, the currency behind it, and a treasury market that has been doubled in performance by gold over the last 25 years. Look at the last few years. It's way higher. 2 years ago, gold was up 40%, the 10-year treasury up 4.5%. Last year, gold was up 70, 80%, 10-year treasury up 4%. Look at it this year. Any way you look at it, holding your wealth in treasuries and in dollars has the lasting value proposition of a melting ice cube, Daryl, and I think the world finally gets it. So a system based on trust that is no longer trusted, that's a problem. And that's kind of, I think, what you see happening. Question is it by design? Is it a way, are we doing this purposely, pissing everybody off? I mean, that's a stretch, but are we doing it so that you see massive dollar dumping, dollar debasement to pay off the debt, to bring back manufacturing? Could it be? Maybe. But if it's not, then yes, we're doing a good job of losing trust. Like, for example, China just signed up all the countries in Southeast Asia, the Asian countries, 800 million people, twice the population of the United States, China's largest trading partner by far, and they're going to be trading with China over the cross-interbank payment system and then the mBridge, which is not dollar SWIFT compatible. And instead of paying for things in dollars, they'll use their own local currencies, which chips away at the dollar settlement status. And then instead, if you don't have all those dollars, you don't need to reinvest them in treasuries, which chips away at the dollar reserve status. Little by little by little by little, chipping. It's like playing the game of Jenga. Which is the Jenga piece that brings it all down? Don't know. I'm not saying that's going to happen today or tomorrow, but you look, the global reserve share of dollars is the lowest it's been, I don't know in how many years. And at the same time, gold has just passed the dollar in terms of central bank holdings as a percentage. Just barely, but it's for the first time ever. So you're seeing a transition away from the desire to hold dollars and treasuries into assets. That's like France, who just brought all their gold back from the New York Fed. Germany's done that, but so too did, the Dutch National Bank, the Czech National Bank, India from the Bank of England, Poland. All of these banks brought all their gold back because they don't trust the system anymore. And when you don't trust the system or the leadership or the institutions, the previous administration, they didn't trust our immigration policy, they didn't trust our judicial system, they didn't trust anything. And a system built on trust that is no longer trusted is not a good omen for the future strength and stability of this nation.
Yeah. So you mentioned earlier just kind of the behavior of, retail buyers of physical gold and silver. One of the narratives is like, there was a lot of speculation. One of the narratives is that because gold didn't run up leading to the Iran war and sold off afterward. The other narrative was that countries needed to get liquid and such. And then you have these other narratives about gold no longer being a safe haven, blah, 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 right? So I'm just curious, what are you seeing with retail behavior? I mean, because you all at Miles Franklin deal with a lot of people that want to protect their wealth and such. And so, what are you all seeing with retail
first of
behavior?
all, before I get there, that narrative again is just stupid. I mean, and that's what they want us to believe, right? And that rates are going higher, so that's bad for gold. Well, how about the fact that for 2-3 years after COVID, rates went higher faster than any time in history, from like 0 to 4+ in a period of like a year, and gold still went to the moon and tripled since then. Here we are since it was 0 in 2021 or whatever, to where we are now, from like 1,700 to almost 5,000 in rising rates. Convenient to ignore that by the mainstream when it's happening. They want us to believe that, but if that were the truth, then why are we seeing record deliveries every single month? Why in the month of February did China import more silver than in the history of all recorded markets going into China ever? The month that it got destroyed. Why are we seeing these deliveries in every single month on COMEX? So far in April, 18,647 gold contracts at 100 ounces apiece. That's almost $1 billion. And 1,753 silver contracts at 5,000 ounces apiece. So let's do the math there. 1,753 times 5,000 is 8,765,000 ounces. And let's multiply that times, silver's up almost $4 right now. It's at 79.20. So let's multiply that times 79. That's $692 million worth of silver have been delivered so far in the first week or so.
$1 billion?
Million?
Yeah.
692,435,000. Okay. But by the end of the month, because that's only for the first, what's the date today? It's for the first 2 weeks. By the end of the month, we'll be way over $1 billion. And it's been way over $1 billion every single month. In February, which is a non-delivery month, 25 million ounces delivered, 39 million ounces leave COMEX. 160% of what was delivered left. 2 million pounds of silver left. Billions of dollars worth left. Who's running logistics? Where are the trucks coming from? Who's doing that? Where's it going? Who's paying for it? 2 million ounces leave the eligible category a few Fridays ago. Those aren't even the bars that are available for sale because no one trusts the system anymore. The narrative that war pushes up the price of oil, which pushes up the CPI, which pushes up inflation, which then makes no rate cuts. Well, that's bad for gold. Well, again, if people trusted the dollar and the Treasury, it would be, but they don't. This is the MOPE, management of perception economics, that my dear departed friend Jim Sinclair used to say. We knock the price down to control the narrative and then stand for delivery because we don't use margin. They knocked off all the speculators, freaked everybody out, and then you see every single month, even in the month of February when the price got hammered, huge deliveries here on COMEX and actually leaving the exchange, the largest silver deliveries in the history of recorded markets in China that month. And I'm telling you, the central banks haven't stopped, and nor have the deliveries on COMEX every month for 18 months. That betrays all of the mainstream narrative, which is still
They saw it as a bargain.
That's right. Let's shake them from the trees. We'll jack up the margin rates. Even the IMF came out and said, it was either the IMF or the BIS, that was not a fundamental decline. It was structural, largely blamed on rebalancing of levered ETFs and margin increases. They said it is not fundamental. It's structural. In other words, it was engineered. Jack margin rates up and rebalance the ETFs that were way out of whack because of silver's rise, and bang, create selling, beget selling, get margin call, I'm out. And it destroyed all of the, like for the refining in this country, the refiners had to bail and say, we can take no new business. They were getting margin called every day. So the structural, engineered price decline fell right into the hands of the big traders. That would be the sovereign wealth funds, the governments, including the United States, in my opinion. All of these countries that want physical possession, that don't use margin, they said, thank you, we'll stand for delivery, bye-bye, at wickedly subsidized prices because of the leverage unwind, which, according to the highest, most powerful banks on the planet, was structural, not fundamental. So it's just a bunch of phooey that the mainstream media, which lacks any integrity or journalistic work effort or work ethic, they just sidestep.
Yeah, so like with retail, like we see this, even in the stock market. Like you got the market makers, the market movers, which are the big institutions that come in, sell or buy whenever there's fear and such, and then then you see retail start to like hop on the back of their coattails, when price starts to move or whatnot. I'm curious, like are you seeing more fear amongst like retail, like, okay, yeah, we got in at these highs, okay, now we're not, we're stepping out of this, or we're going to sell? Like, just curious on what you're seeing. So, and
that's why there's an entire school of investment theory called wave theory. Kondratiev and Elliott wave speak to the cumulative emotions of the herd. And I have seen more than I would like to admit, a lot of capitulation, because they are listening to their money managers. They're listening to the mainstream media that is telling the absolute wrong thing. Again, if price was an indication of value, then why the hell are the most well-informed traders on the globe standing for delivery across the globe nonstop? They use price as a tool of misdirection. And so yes, fear is the most powerful motivational force on the planet. And when people get scared, they act irrationally. They dump at the worst possible time, which drives down the price, which falls right into the hands of those standing for delivery who have the information and the funds. That's exactly what's happening. And even the well-informed alternative side of the table, our side, these people are not immune to the emotional. Look, I'd be lying if I said I wasn't. I've been doing this 36 years. I've lived through every downturn we've ever seen in the last 3.5 decades, and it still bums me out. But I'm at least wise enough through watching it all and understanding the deliveries and stuff to understand where this will ultimately go. But it messes with you. Like, again, it's like I'd be lying if I said otherwise. But you have to be able to separate emotion from rational, logical thought. And if you can do that, it makes the emotions worth less than emotion is important, right? Fear is important at telling you, hey, danger. But you have to try and understand, is this manufactured danger, or is it organic? Is it real? Mm-hmm. And I think the manufactured danger, you can see through it if you look closely, based on the deliveries across the globe, not just here, but in Shanghai and on the London Metals Exchange, et cetera. This run is not over, not even close to being over. And if it were, you would see the central banks dumping. You would see not deliveries on COMEX, you would see the COMEX being flush with metal as everyone was selling it back and getting out, not standing for delivery and taking it out.
Yeah, for sure. So when we had that big run up, a lot of people were, I can't say a lot of people, but many people that I know were looking to sell and kind of liquidate. Silver's over $100. They were trying to sell, and there was a lot of the issues with the refineries and all of that, to where it was creating these huge backlogs and bottlenecks and such, to where people couldn't really get out of couldn't really get liquid, and so do you see that as going to be as prices continue to go higher? Do you see that as going to be a consistent issue, or do you think there's things being worked on in the background to try to alleviate some of those issues?
Yeah, I think the jacking up of margin prices created issues that were maybe not intended. For example, the refiners don't just work with precious metals. They have integral part of the actual economy, and they all got shut down because of raising margin rates. To try to explain what I'm saying, if you're a company of our size that does a lot of business, typically you're going to hedge your exposure. Meaning if you have 2 million ounces of silver in your warehouse, you will sell 2 million on paper. If what you have in your warehouse goes up by $10 on your 2 million ounces, that's 20 million profit. It falls the exact same amount on what you sold short, and vice versa, so that you're never speculating with your inventory. You're market neutral. That's how you stay in business and don't screw yourself when the price falls by 30% like we saw in January. So in early December, let's say December 1st, I'm going to be close on these numbers, it would have cost us $15,000 approximately to hedge 5,000 ounces, one contract of silver. So we put that money in a margin account. Just sits there. It's a collateral account. Just sits there, unless the price moves against us. So 5,000 ounces, call it at $60 a piece back then, would have been $300,000 of silver I could control with $15,000 in my margin account. That's 5,000 ounces. We would typically have 2 million ounces in our warehouse, so you can see the cost is very high to hedge that. You got to have $20 million sitting in your margin account, right? Okay, fine. That's just silver. About gold and platinum. By the beginning of January, that number had gone up 300% in terms of what you needed to have in your account. So 15,000 became over 50,000 to hedge 5,000 ounces. The cost of hedging your position became so high, the cost just became, it had to filter down into lower bid prices. And if you weren't hedging, a lot of the companies don't hedge, and the price fell by 30%. When you're lucky to make 2% in this industry, you're done. You're crushed. You're probably on life support right now if you've been able to hang on, because you lost so much in your inventory. So if you don't hedge, you better back your bid prices way back, because if not, and it goes against you, you are out of business. If you do hedge, your cost went up so much that the cost of doing business is such that you won't make any money unless you start to change things. Well, that spilled over into the refiners. If they have 50 million in inventory they paid for, and they're trying to break it down and turn it into shot and then melt it down and turn it into bars and rounds, that takes a period of time. You got to hedge that inventory. Well, they were getting margin called all through January as the price kept going higher and higher and higher. They had shorted the same amount that they had in inventory, which takes time to refine. So as their price of their inventory was going up, they're getting killed on their short position, and they were getting margin called. And then they kept raising rates on top of it, margin rates. The refiners are like, we can take no new business. We're going to go out of business. We're getting margin called. We're exposed. That's it. Well, the refiners are still months back ordered, and they're still hardly efficient right now. And it created a lot of problems. So I would like to hope that will work itself out in the future. I've never seen bid prices like this ever, Daryl, in 36 years, ever. We're selling pre-65 junk silver right now at $2 back a spot. We're selling it. I've never, ever did that, ever in my career. It's a crazy, crazy, crazy time. Like to the IMF or the BIS's statement that this sell-off was largely structural, raising of margins and levered ETFs unwinding and rebalancing. The unintended consequences have been pretty profound. I think someone probably got chewed out for that, and I don't think you'll see that happen again. That would be my hope. Yeah, for sure. Okay, so many of the big banks, the big institutions, they still have these high price targets on gold for year in and looking on out and such. So are you typically in agreement with that? Do you think we're going to get a period of consolidation? I mean, we went down to what, 4,300, 4,200. Now we're back at 4,100 at the bottom.
Yeah. Now we're at like what, 48, 49.
What are we at right now? Today, gold's up about $60, 4,800, and silver's up $4.50 to roughly 79. So Yeah, I do. I mean, you got all the big players calling, a lot of them, for $6,000 or higher by the end of the year. Could it happen? Sure, why not? Typically, you would expect to see things really take off come September, October. That's usually when you see things move. But look, the fundamentals would support it, certainly. Nothing has changed. If they're right about saying it was structural, not fundamental, nothing's changed. And all of these banks, Bank of America, you know, you got the chief investment officer of Morgan Stanley, who earlier in the year said, sell half of your bonds, the 60-40 rule that's broken. BlackRock just said the 60-40 rule is broken. The chief investment officer of Morgan Stanley said that 60% stock, 40% bond is broken. Sell half your bonds and buy metals. Well, BlackRock is doing the same thing. The lead analyst for Bank of America, Michael Hartnett, said, no, you should have 25% of your wealth in precious metals. Their head gold trader just came out and said that he could see silver between $130 and $309 by the end of the year. So, yeah, I mean, the banks are still calling for it. The logic, if you can separate the emotion, says, yeah, it should probably already be there based upon the demand and the dollar creation and the manipulation and all of the stuff. Sure, why not? But I don't focus on price, Daryl. I look at the fact that if you hold it long enough, the bull market will take care of your entry. The bull market will push this much higher.
Yeah.
Focusing on prices is dangerous, and I think you put yourself out on a limb, but I would say prices will go higher than people think possible.
Yeah. It just seems like a coiled spring right now. I mean, the markets too. I mean, because anytime there's some speculation on there's going to be a ceasefire or we're going to come to an agreement with Iran, like the markets just take off, like, you know, significantly. And it seems like there's a lot of energy being built up into the markets in general, but especially in gold and silver, that, you know, if we do get some type of peace agreement or something like that, I could see this like really taking off.
Yeah, well, that's the silliness of the market, that it thinks in terms of minutes.
Yeah.
Look at the Chinese. Price is getting its teeth kicked in February and import more silver than the history of all of the records going in import-export numbers into China ever. That's the point. Price is a tool of misdirection, and the information that we are reacting to day by day, that's noise. Look at the big picture, the mathematics. The mathematics don't work out anymore for this country in terms of indebtedness and in terms of the trajectory. So I think that's the realization. System that isn't trusted, that is fiscally irresponsible, and is running out of mathematical runway. That's all these countries need to know, and look for every pullback that is engineered by the West stupidly as an opportunity to add to your stockpile at a subsidized rate. That's how they look at it. So yeah, I don't know what the end of the year will be, but go out a couple of years, and I think while this bull market still runs, prices will go way higher than people think possible. But that's not why you own it. You don't own it to get wealthy. You own it because it is wealth, and the most well-informed traders in the world are showing you that right now.
Well, I mean, one thing we know as far as sentiment, you know, which I'm looking forward to seeing you in Boca at RICS symposium. But for them to be sold out and no spots available, I mean, that says a lot.
They've been sold out for a while now, Daryl, like for a couple of weeks for sure, maybe a month or longer. So yeah, there's a lot. I've never seen that before that fast. So there's a lot of demand for this kind of information, a growing expansion of the hard asset community, but still represent but a very small speck of the mainstream of the whole pie.
Yeah, for sure. Well, Andy, appreciate you coming on the show. Very thoughtful conversation and everything.
Always, Daryl. Always good to see you, my man. Always.
Yes. So where can people connect with you, follow you? I know y'all putting out content on your show. You know, you also have you all sell metals and such. So plug the audience.
Our YouTube channel, myself and Michelle McCory, is Miles Franklin Media on YouTube.
Y'all are killing it, by the way. Y'all killing it over there.
Appreciate that. Yeah, it's a labor of love, man, and same back at you. And, you know, the only two conferences I will ever endorse and go to, never miss, is Jay's conference, Vancouver Resource Investment Conference, to which you are one of the main contributors to here this way, and and RICS. But the way to reach out to us, we don't publish gold prices above $10,000. If you would like to get our price list, which will be as good or better than anywhere in North America, it's info at milesfranklin.com, and please put down that you saw us or this conversation. That comes from the VRIC channel, and we will make sure not only to answer any questions that you have, but to send you the price list. We update it twice a week. If you find prices better from a major competitor, let us know. Chances are we'll match it or beat it. Typically never undersold. Info at milesfranklin.com for the price list or any questions. And Miles Franklin Media on YouTube. I appreciate you asking that question and get that out there. But
for sure.
It's just an honor to be associated with you and VRIC and Jay and the whole crew, and it's an honor, and look forward to picking up where we left off, hopefully not too far down the road.
Yes, indeed. Yes, indeed. All right, you all. Well, you all got the information. Thank you for watching today. Be sure to hit the subscribe button if you haven't yet. Love to have your support. And until next time, Andy.